Transitions, the podcast by Ostrum Asset Management.
Hello, everyone, and welcome to this new episode of Transitions, the Ostrum AM podcast that explores the profound transformations taking place in the world of investments and sustainable finance. Today, we dive into a topic that is as technical as it is strategic: ESG data, the environmental, social, and governance data that is reshaping the way we analyze companies, measure risks, and above all, make investment decisions. To discuss this, I'm pleased to welcome two guests who deal with these issues on a daily basis: Sophie Palagos, Credit and Sustainability Analyst, and Marc Estagnasié, ESG Strategist, Cross-Functional Projects and Data. Together with them, we'll explore how this ESG data is collected, filtered, and analyzed, and most importantly, how it becomes a genuine strategic advantage for investors. Hello to both of you.
Hello.
Hello.
First off, Marc, let's start with the basics. What is ESG data exactly?
Let's start with the basics indeed. What is ESG data? This refers to information about environmental, social, and governance performance. The acronym ESG is now essential. This data is not all the same. It can be quantitative, for example, the tons of CO2 emitted, or it can be qualitative, like the quality of social dialogue. It might be raw and scattered in various documents, or conversely, structured and standardized by well-established norms. The main source is often the company itself. They share their data in annual reports, sustainability reports, and through other channels, articles, or press releases. Some information is published by NGOs. Governments and global organizations like the UN or the World Bank also publish ESG data. It's crucial to understand that this raw data is then collected and processed by specialized providers. These firms compile available information. They might also estimate it using their own methods and models. This is where some complexity and added value come in.
Thanks, Marc. So in practical terms, how does that play out in the real world? What different kinds of data are available to us?
The nature and availability of this data vary greatly on a case-by-case basis. Local regulations play a role. For instance, Europe CSRD, the Corporate Sustainability Reporting Directive. For certain companies, the European authorities mandate increasingly strict ESG reporting. However, the Omnibus Directive has simplified things, reducing the number of required data points. ESG data does not replace traditional financial data. It complements it. It offers a new view, another lens, to analyze a company's performance and resilience. So, what do these indicators cover? Environmental E. This includes things like carbon emissions, energy consumption, and action for biodiversity. Social S. We look at team diversity, working conditions, employee health and safety, and relations with local communities. Governance G. This concerns board structure, business ethics, and compensation policies. From these indicators, data providers create ESG ratings. These ratings combine and weight performance across the E, S, and G pillars based on the importance and the company's sector.
We now have a better understanding of the nature of these indicators. Beyond their classification, what strategic role do these data play today?
Looking ahead, regulations, the growing climate urgency, and increased awareness of ESG risk mean ESG data is constantly evolving. Its volume and complexity are growing. It's always changing. For us at Ostrum AM, access to raw data is absolutely key. It's our raw material. But our real added value, what sets us apart in asset management, is our ability to deeply analyze this data. We cross-reference it, we contextualize it. This ESG data analysis then allows us to make informed investment decisions. It helps us direct financial flows responsibly, design relevant investment products, engage in constructive dialogue with the companies we finance, and ultimately define and deploy our overall ESG strategy.
As Marc mentioned, there's been a surge in ESG data, whether it comes from ESG data providers, non-financial rating agencies, or companies, particularly in Europe. Sophie, how do you view this data and what limitations should we take into account?
The sheer volume of ESG data presents a challenge. It demands skillful navigation and a measured perspective. A key issue is a lack of standardization in how companies calculate CO2 emissions, with reporting scopes often failing to include all companies and subsidiaries. We frequently encounter a deficit in consistency and low correlation among ratings issued by different extra-financial agencies. Consequently, a thorough understanding of these ratings' underlying assumption is essential, especially for discerning the most pertinent ESG elements within their assessment. Put simply, a given score should be approached not as definite truth, but with an informed and critical scrutiny. There is the general lack of maturity of ESG data and a lack of comparability. While financial data is tested and approved and highly standardized with key indicators like turnover, there is still a long way to go with ESG data, even though we are making progress. For example, comparing companies' carbon footprints is difficult because Scope 3, indirect emissions, is complex to measure and varies greatly from one company to another. Standardized methods are still lacking to evaluate them reliably. This is why, in Sustainability and Credit Research Department at Ostrum Asset Management, we try to identify the most material Scope 3 emissions for each sector, and we engage with companies to encourage them to report at least on these. If we look at the banking industry, where the bulk of emissions are Scope 3 emissions called financed emissions, which derive from their loans and investment portfolios, the challenge of reliable and comparable data is huge. We are still far from being able to compare banks by the carbon intensity of their activities. Lastly, on a broader scale, a significant challenge lies in the global disparity of ESG data provided by companies, both in terms of quantity and quality. European companies have responded robustly, significantly enhancing their sustainability reports to meet this need. They have also formed dedicated ESG teams, including investor relations professionals specializing in ESG. They now serve as key interlocutors for discussing companies' big ESG issues. This is less the case with the United States, where companies have weaker incentives to report ESG data. We are therefore in a two-speed world, and the gap is widening.
There's a lot of talk about the quality and the surge in ESG data. But in practical terms, what challenges do you face on a daily basis?
With so much ESG data available, one of our first steps is selection. Which indicators matter most, and where we will get them? At Ostrum AM, we have a clear principle. So we prioritize data directly reported by companies over estimates from providers. Why? Mainly because current regulations, like the CSRD we just mentioned, strongly encourage us to rely on information published by the companies themselves. It's a matter of reliability and transparency. This selection process presents several challenges. First, choosing the right data provider. This means finding one with relevant analysis tools and robust and transparent methodologies. The second challenge is created by the extremely dynamic nature of this market. The ecosystem of ESG data providers is evolving very quickly. We must constantly monitor these changes. This allows us to adapt our subscription, our internal tools, and best meet client needs, our own requirements, and of course, regulatory changes. Managing costs is also a real issue for our industry. These costs have significantly increased in recent years. To understand the current environment, we need to look at the significant evolution of ESG data providers over the last 20 years. We've seen a wave of consolidation. First, the major traditional financial rating agencies invested in ESG, often through acquisition. For example, Standard & Poor's bought Trucost in 2016 and Moody's acquired Vigeo in 2019. This trend has intensified. Even recently, Moody's stopped its ESG rating activities, now using MSCI.
But to what extent has this consolidation transformed the landscape?
This consolidation moves and ownership changes are significant. They require us to be careful about dependence on any single player. Imagine, a methodology could change overnight, impacting our analysis. We must be aware of these transformations and, above all, demonstrate agility. Amidst the dominance of large US players, it's worth noting several independent actors are playing important roles, especially in France. Think of Carbon4, Iceberg Data Lab, or Etifinance. However, smaller firms may have less comprehensive coverage compared to the global reach of US giants. Finally, the landscape is being enriched by a new generation of players that could be called alternative. They leverage artificial intelligence extensively for their analysis. Names like Clarity AI, True Value Labs, or Sesam are good examples.
Thank you, Marc. Sophie, what are the key challenges of using ESG data in corporate analysis?
ESG data is crucial and is now an integral part of our company analysis. In 2024, Ostrum Asset Management enhanced its sustainability analysis by integrating the double materiality of extra-financial issues. This approach recognizes that economic activities, regardless of their nature, depend on an ecosystem, environmental, social, economic, and they also have an impact on it. Ostrum Asset Management therefore assesses this from two perspectives. Financial materiality, the extent to which companies depend on this ecosystem. Impact materiality, the impact companies and their value chains have on this ecosystem. We thus analyze double materiality issues at sector level. From this, we identify issues that are already material for a company or those that could become so in the future. This issue can represent risk or opportunities. Double materiality allows us to focus on analyzing specific extra-financial dimensions of companies we wish to engage with, supporting the evolution of their practices and behaviors. This notably includes the transition to a low-carbon world. One of the challenges with double materiality is a long time horizon of ESG issues, which often extends far beyond our credit opinions that typically cover 12 to 18 months. For instance, climate change unfolds over decades. Therefore, it is essential to have reliable and consistent ESG data that we can track over time to, for example, monitor companies' progress in their climate transition. This includes carbon reporting with reliable absolute and intensity emission data that can be tracked over time. Having reliable data allows us to judge whether a company's announcements will be sufficient to achieve its climate ambitions. Given the provision of extra-financial data, it is crucial to have an internal filtering process to ensure the quality, consistency, availability, and traceability of ESG data used in our analysis. Finally, there is an increasing awareness of ESG issues among stakeholders, clients, institutional investors, society. ESG topics cannot be ignored or treated as a tick-the-box approach. They must be integral to the analysis of an issuer's operational and financial profile. This highlights the need to structure and identify data, especially for critical themes. While today climate is a dominant concern, tomorrow biodiversity and human rights will demand even more robust and accessible ESG data.
Now that we understand the importance of ESG data, how exactly do you incorporate it into your company analysis?
At the Sustainability and Credit Research Department, we play a key role of support of the investment decision. We analyze the financial profile of companies and project the direction of fundamentals. All of this is aimed at identifying investment opportunities and, of course, avoiding default. ESG data informs our financial risk assessment, evaluating an issuer operational positioning and financial resilience. ESG elements are integrated at all stages of our analysis because they can affect a company's industry or its economic model and have a significant impact on its financial situation, both today and in the future. When combined with financial elements, they enable us to identify companies that will outperform their peers fundamentally. Thus, analysts systematically identify all environmental or social factors likely to be relevant for the company. For example, within the automotive industry, the reinforcement of worldwide CO2 regulations, with the exception of the United States, is noted. This is a major factor that automotive manufacturers must consider in the development of their product portfolio and the electrification of their vehicle fleets. Governance is a crucial element of evaluation, as it can drive management behaviors that has a considerable impact on a company's future credit risk. We deploy two complementary products. One, issuer credit analysis, conducted with a fundamental analysis process that integrates material ESG factors, and two, the analysis of issuers from a sustainability perspective. The latter allows us to identify ESG themes on which we wish to engage with issuers, particularly on climate-related topics. Another application of ESG data is the analysis of sustainable bonds. In our green bond analysis, we analyze companies' climate strategy. It is also essential to have ESG data to ensure that the investment made are consistent with the published framework for sustainable bonds. Finally, exposure to controversy risk can damage a group brand image and also impose significant financial penalties. While well-published example includes large maritime oil spills or fines related to asbestos use, increasingly accessible information means that any breach of laws, regulation, or other misconduct can potentially impact the financial profile. Our role is to estimate the probability and magnitude of such an impact. We therefore rigorously assess controversies and monitor action and remediation plans. For instance, we monitor controversies in the chemical industry concerning product health and safety issues.
Thank you, Sophie. That's very clear. We can now see how this data fuels the analysis. Marc, how does this play out at Ostrum AM? What sets us apart in the way we use this ESG data?
Once we have selected our ESG data and providers, you might think the job is done. But think again, this is just the first step. The real work starts next, analyzing and integrating this data into our processes. As Sophie mentioned earlier, this information feeds into our credit analysis. It's also fundamental for guiding our portfolio managers' investment decisions. Let's take a concrete example. For many funds or mandates, we have carbon emissions reduction targets. This means our managers need precise knowledge of a company's carbon footprint even before investing, and they need to track this emission trajectory over time. This allows a manager, for instance, to choose between two companies. They might favor a low-carbon player or select a more polluting emitter that's committed to a significant reduction path. Beyond these choices, regulatory requirements, like the French SRI label, impose specific constraints. For these labeled funds, for example, a fund's overall ESG rating must be better than its investment universe. This means our managers must pay close attention to each issuer's ESG ratings, and in the process, they can, of course, rely on our dedicated teams for in-depth analysis and informed advice. But ESG data is not just for stock picking. It's also an essential tool for our dialogue with companies. It allows us to engage with them to encourage their ecological and social transition, especially when they face controversies. And that's not all. This data guides our votes at general meetings, helping us support resolutions aligned with Ostrum AM's ESG policies. When ESG data is at the core of the investment thesis itself, its utility is even more pronounced. This is the case, for example, with our Ostrum Climate and Social Impact Bond Fund. This fund, with both SRI and Greenfin labels, and classified as Article 9 under SFDR, focuses on green, social, and sustainable bonds. These financial instruments are specifically directed towards projects with a direct positive impact on the environment and society. In reality, ESG data is everywhere within our entire value chain from start to finish. Our managers use it in their portfolio management, to exclude controversial sectors, or to build impact strategies. Our risk teams monitor specific ratios based on ESG metrics, and our reporting teams then translate this visually and concisely for our clients. This engagement is mutual. Our institutional clients at Ostrum AM are also increasingly integrating ESG data into their own analysis, even if they don't always use the same providers or methodologies than us. This creates very rich exchanges between us and our clients, understanding their perspective, their own constraints, their own expectations, especially as players and methodology evolve, is a key component of our relationship.
Sophie, what are Ostrum AM's key strengths that enable you to effectively incorporate ESG data into your analysis?
We have an organizational structure that combines specialists in thematic areas, climate, biodiversity, regulation, within the Sustainable Transition Department. This department comprises 9 people. And we have sector specialized credit analysts. We have 22 sustainability and credit research analysts worldwide, deeply expert in their respective sectors. This makes our research team one of the largest in Europe. With this combined expertise, we can conduct our analysis of companies' double ESG materiality, identify material ESG factors for issuers' financial profiles, and assess whether announced climate transition pathways are credible, necessary, and sufficient. Let's take the example of utilities. Electricity providers operate in a highly CO2 emitting sector. Even though vertically integrated utilities are well advanced in their green transitions, challenges remain in reducing emissions while meeting the growing demand for electricity driven by electrical vehicles, data centers, and the overall electrification of the economy. This is a challenge our experts closely monitor, as there can be factors to watch that could impact corporate decarbonization efforts.
Thank you, Sophie. Thank you, Marc, for these insights into how ESG data is transforming not only financial analysis, but also day-to-day investment decisions at Ostrum AM.
Thank you, Clément.
Thank you, Clément.
It's clear how this data, long considered peripheral, is now central to performance, resilience, and responsibility. Thank you all for tuning in. If you enjoyed this episode, check out the rest of the Transitions podcast series on any podcast platform or our website, www.ostrum.com. See you soon for our next episode.